given everything we've talked about this morning, I think it'd be helpful to end with some of the highlights of the team's view and maybe the outlook for the year ahead.
Yeah, sure, Chris. And we've touched on it already, but and maybe I'm beating a dead horse here, but while inflation risks rather than growth expectations have driven the recent pivot from the Fed, we do expect that growth. As I sort of mentioned just earlier, growth will remain above trend, but will moderate this year. Again, we'll still see likely strong GDP growth coming in near 3% here in the United States, closer to 5% across the entire global economy. And that's direct result of fading expectations for fiscal stimulus, but we also have been seeing estimates lower themselves for first quarter GDP already as we've gone through just a couple of weeks here in January, which could lead to lower estimates throughout the year as well as the global economy deals with the Omicron variant. And so ultimately I think we'll see growth continue to slide closer to the levels that we saw prior. In the previous economic cycle, near 2% year-over-year GDP growth as the year comes to a close. But overall in aggregate, I think the U.S. economy will have a very strong year. Again, labor market and U.S. consumer, 2/3 of the economy, and they're really fantastic shape right now. Obviously, this is very supportive for the global stock market, with the expectation that profits will continue to grow, at least here in the United States, in the mid to high single digits, with returns potentially to follow. Unlike prior years where the market has benefited from multiple expansion, so that is the PE ratio going from 20 to 22, for example, we really think this year will, like last year, largely be driven by profit growth. And so just companies obviously making more money simply, which certainly could be threatened by wage growth and higher input prices persisting later this year. Again, similar to 2021, we actually saw market multiples or market valuations come in. Despite seeing again a record year for the stock market, and again that had been driven from profit growth, which really outperformed analyst expectations over the course of the year. Profit margins are currently standing about 12.3% versus 11% before the pandemic. And so as we've heard from clients concerned about why the market has gone up so much, part of it has been where interest rates are, and just there are no other alternatives, or TINA, as the financial media likes to say. But the other big piece has been profits have actually really grown over the course of the last 2 years. And again, a lot of that may be very different from Main Street. But as we look at the concentration, especially within the technology sector and healthcare within the indices, obviously those are areas that have actually benefited quite a bit from the global pandemic. Company commentary from the third quarter continues to suggest that companies were able to leverage their pricing power and pass on price increases to consumers. And this will be a very, very important thing to watch for, especially if you manage money outside of the assets that we work with you on, because there are going to be certain companies and sectors and industry groups that are going to be more susceptible to rising input costs, putting risk to their profit margins and therefore upside for the remainder of the year. Within the bond market, despite rising rates, we're obviously encouraging our clients to not discount the value of bonds as a diversifier and a store of value long term, providing protection and ballast should economic projections fall short. And we believe rate hikes expected later this year really have already been priced into the market, especially the last 2 weeks that we've seen here in a pretty significant move here in U.S. rates. But keep in mind that here in the United States, the U.S. fixed income markets remain both a safe haven for global investors, due to a high number of quality U.S. corporations that are issuing debt, but also the U.S. Treasury market remains in high demand, especially as you look outside the U.S. and the developed world, especially in Europe, where yields are much lower. And so, despite credit spreads reaching record lows, we still favor corporates in this environment, but we expect more of a coupon clipping year with a source of return for the fixed income market or bonds to largely come from the income that's generated, as opposed to price appreciation, which will only take place if the expectations for rates are actually lower. As I mentioned earlier, we expect inflation getting under control, and while year-over-year headline numbers will still be startling, one important thing to focus on and continue to focus on is month-over-month changes. Again, for example, December CPI was up about 0.5% month-over-month, but November CPI was up 0.8% month-over-month. And so, we expect that international shipping networks and workforce participation to loosen up and really straighten out some of the supply-demand equation. At the same time, a shift of purchases from goods, Americans were buying at record levels when we're all stuck at home, to the services like travel, leisure, and even dry cleaners and hair salons should put a more sustainable path to the historically elevated but manageable inflation to closer to that 2 to 3% range. For companies, I think these dynamics may offer opportunity to make price increases permanent, further bolstering their bottom line. And I see a question here actually, related to inflation being a one-time step up, and it's saying, do you mean that cost of housing, rentals, and other living costs will step up and recede at previous levels, or is this a new level and will hold there? And one of the, I guess, tail risks, or actually tailwinds for the U.S. stock market or global stock market is that we actually don't see companies reduce prices again. And so it'll very much, I think, to be industry specific, sector specific. Obviously, the competitive landscape is very different, from industry to sector and so on. And so, we could see, I guess to answer your question, I think, housing, for example, is probably a good one. I highly doubt that we'll see, I guess, rents, go down, for example. However, for companies that say are manufacturing or providing, say, software, if they increase prices by 4 or 5% in last year, unless there's extreme competitive pressures, I don't see them actually cutting prices in the coming year. And so ultimately, as their costs begin to either decrease or not nearly grow as much, they could fall straight to the bottom line. And so certainly could be a nice tailwind for the U.S. stock market. Moving on to Washington, my least favorite topic, and always a source of market uncertainty. Every day we see it. At least not right now. We were actually in a blackout period of Fed governors speaking, but we've seen certainly Fed governors spook the markets. We don't necessarily see a prediction for doom or gloom to come. It is an election year. The Fed traditionally uses some of the commentary that they make in the media as a bully pulpit to drive behavioral change without actually having to change Fed policy. So keep that in mind as you hear Fed officials speak. But the key risk in our mind is the Fed either takes too long to act and ends up slowing the economy after it's already slowed, and just overreacting to these inflation risks that we've seen really bubble up over the last couple of years. From a legislative perspective, it looks like the Biden stimulus proposals are dead on arrival, which I guess turns our attention to the midterm elections. Traditionally, the markets like gridlock and they like certainty, and so what remains to be seen, we'll have some volatility later this year. And finally, monitoring the plateau and hopefully drop off in Omicron cases, understanding there is a lag effect to hospitalizations and death, but it certainly seems like this variant is far less lethal than others. And as we likely transition or hopefully transition into the endemic phase, where COVID greets us each winter like the flu, we need to have tools to manage outcomes with vaccines and therapeutics. And so, fortunately, we've seen schools and daycares, move to being fully open, which is, one obviously key to expanding labor force participation. But as Omicron has shown, even, other less, lethal variants create disruption to the economy here in the short term. And so obviously we'll be watching for that as well. But I guess in summary, this outlook is really the midpoint for the variety of possible outcomes this year. It is important to know that we'll likely get many ups and downs and provide opportunities and challenges as we go. And the most important thing is a diversified portfolio, rebalancing when appropriate. Our approach tries to find a middle path and balancing risk reward. And economies and markets generally do not move in a straight manner. It's more likely we'll see some challenges in some areas and some great outcomes in some others. And so either way, our approach to diversification and rebalancing will likely soften some of the edges of what could be a potential volatile landscape. But please, know that we're certainly keeping very close tabs on the situation and ultimately positioning, your portfolios in a way that we think is prudent, given these risks and also opportunities in the landscape as we look ahead.